For decades, Europe and the West have positioned themselves as Africa's preferred partners across aid, peacekeeping, and trade. But that legacy has long been in question. And today, Africa is in the driver's seat. Aid flows are less central, trade patterns are shifting, and countries across the continent are forging new partnerships with China, the Gulf, India, and most importantly, among themselves. In this context, the West is now a partner among many. The question is no longer whether the West stays relevant, but whether the West and Europe can evolve into a responsive, long-term partner that African countries actually want and need for their own priorities. As African nations grow more assertive in defining their own economic destiny, this session will explore how the West can reimagine a more equal, strategic, and future-oriented partnership with the continent. I'm Kirpir Chahal. I am here as the head of infrastructure partnerships for Africa and the Middle East from the British government. And I'm here today with my esteemed panelists, Karim El Anoui, Executive President of the Policy Center for the New South in Morocco, and Gwendolyn Abuna, Managing Director for EcoBank in Cameroon and the CEMAC region. Welcome both. Let me start with a very quick question. With influence in Africa being measured by donor flows for a long time, maybe that lens is now outdated. How has the framing of influence in the region shifted for Western or European actors? Maybe, Karim, did you want to start?
Yeah, I think, thank you, Kirpir. Pleasure to be here. I think we're in a more open world, and influence is about seduction. It's not about rents that were inherited, I would say, from the post-colonial period. So it's more complex for advanced economies to deal with Africa today because it's more competitive. It's a more fluid world. So what you're seeing in this area of aid and relations and so on and so forth, I think is influenced by the shifting geopolitical landscape and the internal challenges that the advanced economies, our traditional partners, are facing today. So I think we're not, yet where in an equilibrium. So let us see how it evolves. But we could already say that they're more interested in us. In fact, they're looking at Africa in a different way with new glasses because they're challenged by the sort of reshuffling of the transatlantic relation. But it's going to take time for this to sink in deep down inside, and in fact to reach a new aggiornamento in a way. So I think we're in that period. It's quite interesting, and and we have to look at this as an opportunities from the standpoint of the continent, without also a spirit of revenge. I think let's keep our cold heads and look at this as a sort of new area, a new cycle that will be beneficial for all of us.
And Gwendolyn?
Yeah, just to follow through, I think we have moved from that donor-recipient dynamics to true mutual prosperity. And there's also this mutual value and mutual respect, because for long-term partnership models now, you have to really understand African priorities as driven by African leadership. So that changes the dynamics of the relationship and the influence. And lastly, it's no longer about imposing solutions. It's more about co-creation of solutions. So for me, that's how I would describe it.
I really like that. I think co-creation, incredibly important. Speaking of long-term partnerships, Karim, can you tell me in contractual terms, what are some of the components of a really co-created long-term partnership?
I think it will have to be beneficial, of course. I think most countries of the continent are, as you know, we still have 23 of the 26 low-income countries of the world are in Africa. And those have very specific challenges. And I think financing remains an issue. It's a catch-up sort of growth strategy that they have to get into. The middle-income countries like Morocco are more on, I would say, market-based type of relation with foreign direct investment that matters the most, and technology and and sort of rather than financing flows for long-term development. So we can tap the markets, we can, and it's, you take Morocco, what we've done in the value chains in the automobile and aeronautic sector, which is mainly driven by European companies, has been quite successful, and we've been able to integrate ourselves in the global value chain of those sectors. I think the kind of things you want to see. What's not working today is organizing a sustainable and at-scale flow of private capital. And I think that's the key, rather than, let's say, official flows of aid. But we can come back to that discussion if you want on the financing side.
So let me move to you, Gwendolyn. Speaking of availability of capital, what shifts are you seeing in terms of appetite for private investment, specifically in Western and Central Africa?
When you look at the financing now, typically in the past it was more, I would say, plain vanilla. But now we are seeing a blend of blended financing. We are seeing more public-private partnerships. We are seeing de-risking opportunities to help make the risk more acceptable by having public sector, DFIs, and international financial institutions like the AFDB, the BEI, the IFC coming in with more de-risking solutions, and not focusing on the usual, I would say, sectors. Before it was more infrastructure, but now we are seeing something on agribusiness. We are seeing on SMEs. We are looking at more developmental issues around women entrepreneurship. We are looking at fintechs. We are looking at startups. So I think with this new way of providing support and financing options, it's helping us to have a larger scale development than what it used to be, because we have to take note that Africa is not the same today as it was 20 years ago. So if you're coming in to give the same financial solutions or the same support, you're not going to create value. And we are now also seeing a lot of impact financing and green bonds coming in, looking at the sustainability aspects and environmental aspects. That makes it more interesting. So a lot of things are happening. We are seeing a lot of support, and the different tools I've just mentioned are having the right impact, even though there's always room for more improvement.
And to go back to your point, and both of you feel free to come in on this, how can Western states and European states be more strategic in helping to de-risk some of the environments for private capital and crowding in more private capital?
I think if I may, it starts at home. And I think countries should fix their policies, they should fix their regulation, their business environment, stable macro policies, less of fiscal dominance where financing goes to the treasury largely creating crowding out effect for the private sector. So it really starts at home. And we have not yet cracked the code of international finance to attract large capital flows of private capital. I insist this is what matters the most for the continent. And you have excess savings in advanced economies, potentially high rates of returns on the continent, but the perception of the risk still remains, and I think it is right. So, investors, they will come if the risk return ratio is at the appropriate level. So I think we should insist on the fact that we need good policies in countries to attract capital. They need to deepen their financial market. And then will come a strong response from the private sector. Multilateral Development Bank can help, but they can't solve that. We've been trying using the IFC as a guarantee mechanism, etc. But in the end, if you don't have a pipeline of projects, money is not going to come. You will keep on doing what we've been doing the last 50, 60 years. It's great. Using the World Bank to finance roads, infrastructure, etc. But I think the code, what needs to be fixed is really policies, financial market, stable macro policies, and of course politics. Stability, political stability is essential. So.
And Gwendolyn, beyond the domestic policy environment, what are you seeing works well to crowd in private capital. Is there any examples you can share? Are IFIs, DFIs playing a role?
Definitely. I think what I'm saying is that loans are now being tied more to projects that generate economic returns, and foreign exchange. And transparency is also key. Transparency is so key in these debt contracts and is paramount in strengthening what African countries can receive. And there's also a shift towards equity investments and public-private partnerships, which is critical, where the risk and reward are shared and can reduce reliance on pure debt. We are also noticing that there's a lot of focus on the sustainability agenda and the environmental agenda, which is something that in our African countries, it was not top priority because there's a skills gap there. But that is becoming increasingly important, and we are coming in to call on consultants, on those that can give us the knowledge and the guidance that is needed so that the projects that we present are actually fit for purpose. And you'll see that in the financial sector, most of the banks have changed their credit policy to include the social, environmental risk aspect that did not exist before. And they are also investing in training the credit officers to be able to evaluate this risk because it's a key component in how we get financing from the DFIs. So we have had a lot of DFI financing and support because, in Central Africa, we have short-term money. The money we have in banks are from people's savings, so you cannot give long-term financing. So that's where the DFIs and the IFIs have come in because they can provide that long-term funds that we need to do agricultural projects, to do infrastructure projects that span 12 to 14 years that the commercial banks could not do. So there's liquidity, but the liquidity is short-term. So also having that possibility of equity coming in, it helps us to gain scale. And the support that we are having or giving to governments through the securities that we purchase because we have short-term funds also helps the governments to be able to do other projects on their own from the financing that they get from commercial banks, from the purchase of securities in the primary market. So a lot of things are changing, shaping up, but all of the actors have to continue to play the role that they should play to make it gain scale.
That's really interesting. What I'm hearing, so a lot of the key components of the partnership, so it's aligned priorities, commitment to sustainability, risk sharing. So I think
but
to
there's
bring
no
that
way out of the private capital.
Yes.
I mean, whatever size you give to the World Bank or the African Development Bank, it won't be sufficient to finance the emergence of 23 low-income economies and middle-income economies of Africa, let's say to over a 50-year period to reach high-income standards. This is about private capital. And private capital is about trust, predictability, competition, clear rules, clear regulation, good policies, competent human capital, etc., etc. So I think there's no way out of the real discussion for us on the continent is really how can we have good policies, efficient policies, transparency, and long-term visions of. And some countries have made, immense progress over the past couple of years or decades. So while we need to continue to sort of fight for larger multilateral development banks, increased flow of concessional money, etc. I don't think this is the end game. The end game is really, they can be an enhancer, a catalyst that will come, but the end game is really private capital, foreign, but also domestic, that needs to be invested in productive productive activities, and not only in real estate as we see in many countries, or buying government bonds to finance the deficit. So I think...
So can you give me an example, Karim, with regards to Morocco? What kinds of regulatory changes is Morocco focusing on to enable that, given the kind of number of partnerships the country is signing?
We've been doing quite well, and a few other countries, of course, over the past, let's say, 25, 30 years. Morocco has attracted in net terms, in net inflows, around 2.5% of its GDP on annual average, which is quite it's decent. And this has been possible because of good regulation, competition, predictability, underwriting by the government, as Gwendoline said. Sometimes often governments need to underwrite and take some of the risks and to organize it. That was what was at the basis of the success in aeronautics and automobile today. I mean, Morocco exports close to 600,000 cars a year, which is the largest exporter in Africa. And this has been possible because we had good policies, regulation, transparency, long-term vision, stable rules, and true for private, for foreign and domestic private capital. There's no secret to that, as you know, all the development literature has shown over the past 50, 60 years. That includes also advanced economies and their policy that were conducted post-Second World War as well.
And Gwendoline, what kind of partnerships are you actually seeing are delivering value in the region, specifically, again, West and Central Africa? Who is just making deals and who is enabling transformation?
And that's a very interesting question. You know, as Karim was talking, I was just going through my mind at what happened after COVID or during COVID with the regulator and the financial sector. And you saw that the regulator stepped in and said, do not distribute dividends because we want the banking sector to remain strong. We want to have capital and equity. And looking at it from a banker's perspective or an investor's perspective, you would say, oh, why are they stopping us from distributing dividends? But I think it was a very positive safeguard measure for the CEMAC region that our regulator, COBAC, put in place. And we now see the benefits of that because we're able to build up equity and capacity to solidify the financial sector. The second thing is, during the COVID term, almost all the CEMAC countries benefited from the IMF support. IMF is good because it gives support, but as usual, it creates increased debt ratios for the countries involved. But what the conditions that were imposed to the countries to get that IMF support helped us in terms of transparency, like my colleague was saying. Transparency helped us to work on the governance, on sustainability measures, on our fiscal policy, which ultimately, after the loan is paid off, it would be a capacity belt for the countries in question. And I believe that the types of partnerships we want to see are not partnerships that just come to give aid. That time has passed. It's partnerships that would invest in the local businesses, partnerships that will enable use of local currency. So the debt should be in local currency. The loan should be in local currency to avoid that foreign exchange fluctuation that normally impacts us. You know that we have weaker currencies, and receiving funds in foreign currency, when there's a fluctuation, it has an impact. And also strengthening local businesses, because at the end of the day, we should be able to strengthen local businesses for them to take the movement forward. It should not be aid coming, when it goes out, everything falls. No, there has to be local capacity belt, strengthening of local businesses so that they can continue with what we hope to see. Because
that's absolutely
the West should benefit from Africa, but Africa should also benefit from the West. There should be mutual exchange and strengthening of each other so that everybody can continue with the right agenda.
Absolutely. I think that sustainability aspect is key. And there you have it, Africa in the driving seat, telling us exactly what it wants from our partnerships. So the West and Europe just need to listen. Thanks, everybody. And thanks, Karim and Gwendoline.
Thank you very much for having us.